You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, the talking points of variable and indexed universal life.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, co-hosting last week and all this week, Eric Palmer. Welcome again, Eric.
Glad to be here.
Well, we're talking about our income series, and people say, Steve, you guys are getting intense on this show. I mean, you're talking about minutia, but we want you to know, you don't have to learn that, but we're knowing it. We have to know this stuff.
Right.
Now, one of the things I want to talk about today, because one of the purveying issues that we talk about in indexing is preservation of principal. Now, before I get into this, I just want to give the caveat, and Eric, you can chime in, of course. We just received a retail case. I won't tell you who this went to, but it was $20,000 in income. Why did the retail client choose our firm to do this business, which we gave to one of our agents, and it was a 20 grand annual premium? Eric, why did that client call us and wanting to do business with us? What was the issue?
Well, we were actually, it's an issue that we're all kind of familiar with, but I was shocked in the way things came about. The individual had gone on the internet and looked for answers to one major question that they had about index universal life insurance, because the individual was doing some research, and it was about what are the real fees, because I always hear about these 0% floors. And so all the videos and all the advertising out there just talked about a 0% floor and you can't take a loss. And something we talk about all the time on our show is that 0% floor only has to do with the interest crediting rate, has nothing to do with the total mechanics of the contract.
Correct.
So in a year where you're credited zero, there could be a minus return because you have all the cost of insurance and moving parts of the contract. Not to mention, when we're now in a loan stage, maybe we don't take a loan that year. We, as you call them, the bad boy year. We don't. Right. Maybe we do a withdrawal basis instead of. So we talk about some of those things that are a little bit more, I would say, true about the way these contracts perform. So the client watched our video and then actually appreciated the fact that we were most honest about it. And so when we put our agent in there, the conversation went a little something along the lines of I was surprised that you're the only ones that talk this way, but I'm still interested. So that was the key part for me to really focus in on is despite the fact that the client realized there were still moving parts and costs that could bring down or potentially create a negative return in any given year, it was far less than the possibility of a negative return that they would have taken had that been an equity or another type of investment that was exposed to a loss. So when you have a losing interest rate year that's negative and the cost or the fees associated with the product, it's far worse than it is on the life insurance side of things.
Well, one of the things I always want to talk about is how do I mitigate risk? And the first thing I need to know is how do I actually measure it? Now, in the S&P 500, which is the most popular indexing product, you have to look at indexing from a risk point of view. And every day I troll out to the VIX report, which is the 30-day, where is the S&P going, right? And I always look at the VIX, that shows the volatility of where the S&P may go. And I want to look at that. That is only a 30-day period. Of course, we're doing a long-haul investment, so it's not that critical. I just look at it. I just kind of get a pressure test.
Right.
But I want to talk about not so much the VIX risk, but the risk for a client. And one of our show giveaways today is I have two, and I'm talking excellent surveys for your client to take. You should order that at thebiz at brokersalliance.com. What it does is it measures the client's propensity for risk, and it really, in my view, reveals the heart or the psychosis of the client, because you really need to know, does this client after 2008, are anybody really into risk? A lot of people are not now.
Right.
And so when you take this test, it'll really help you understand your issue of risk. Now, we've just disclosed the expense load risk, which of course everybody has no matter what investment you're using.
Right.
But what we want to talk about always is the client risk. So we have a show giveaway today that actually asks questions. And what it does is it actually measures how long are you going to need the money, when are you going to take constructive receipt of it, what kind of principal loss could you incur, how do you feel about that, when do you think you're going to start taking money out, and how long do you think you're going to live so that money is going to be there if you decide to be the Guinness Book of World Records holder.
Right, and what's really important to remember is by by no means are we anti-equity or saying don't be in the market or don't be in funds or don't participate in anything other than insurance. What we're saying is that the foundation of a lot of the principles that you need to follow on a financial basis, so planning for income, planning for indemnity needs, planning for the past or the transfer of your wealth. Let's make those foundations built around some things that we can measure volatility and control some of the moving parts a little bit more than, say, being directly in the market. What you're going to find with this worksheet, I think that's important to note, is you will find there is some tolerance for risk. But what clients are more into these days is taking care of all the basics first. Let me get my income, let me make sure I've got the paycheck coming in, and then I'll think about risk. So you build your house, you frame it, you buy it, you got the whole foundation. Now then you go in and you buy the couch and you buy some of the accessories. And that's really what the market, I think, represents for people, is the extra money that they want to participate with. So when you do these worksheets, keep in mind, we're not trying to sell people out of participating in equities or contributing to an IRA that's got some mutual funds in it. All we're telling them is that think about the foundation first, and insurance is probably going to carry less risk and more predictability than some of those alternatives.
And remember, one of the big complaints of the last 4 to 5 years, especially after 2008, is the clients did not understand their own exposure, and they didn't understand their own psychological propensity for risk.
Well, and there was a research program that went down by Transamerica that said 47% of Americans guessed on the funds and the options that they chose inside their retirement plan. So a lot of times, our consumers are guessing as well. So we have to keep that in mind. They know they want some risk, and they're guessing at which risk to take.
I'm suspicious that half of the agent population was guessing as well. Oh my God. Well, I'm only kidding. I'm only kidding. When we come back from the break, we'll address the Index Universal Life and walk through some of the bullet points that you're going to need to know. Hey, and don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaways at thebiz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor and broker-dealer compliance officer. Now we're talking about Index Universal Life Insurance, and we're going to walk through some of the bullet points, and we're going to compare it to VUL because I just want to make sure you know what you're getting into. Now, as a VUL, and remember, I sold this like there was no tomorrow. I mean, back in the day, and I was using indexing inside of VUL because that's all the game there was.
Right.
When we did this, I always liked to participate because back in the day, we were showing double-digit rates of return before 2008.
Right.
Because they were. We just used true historical numbers. The M&E charge was only 20 basis points. It was pathetically low. Some even as low as a dime. So it's very economic. And I usually call indexing, we're going to get into this tomorrow big time, the poor man's portfolio. Right. So when I'm looking at this, I know with a VUL, if I'm with S&P or any other equity, I get not only the performance, the dividends. I think that's all great. So I have no caps, no limitations. I can go as far up as the market wants to go. If I was in this the last 5 years on the VUL, that might have been a pretty good deal. I mean, because it really popped. Now, what's my downside? Well, I have a downside. I could have lost a good portion of this. And remember, the average VUL contracts that I looked at on in-force ledgers, right, lost between 30 and 40% of their cash values in 2008 and 9. That's a lot.
That is a lot.
Now, people were really put out by that. And even though we had suppressed death benefit, showing the smallest income we possibly could, we still took a major cash value hit. So you just got to remember, with VUL, if you're in the non-qualified market and you want to use, and you're already using mutual funds anyways, and maybe you're dollar cost averaging like we talked about on Monday's show, I have no problem with that. Go ahead and do that. But if you say, gee, Steve, I don't know about that, what is the issue with indexing? Well, think about it, Eric. I mean, we don't have dividends with the S&P 500 as one example.
Right.
So that's a complaint usually, but the caps are kind of high.
Well, the caps are extremely high, and I use this example a lot. We have a little calculator that we put together where, and I take the dividends out of the equation for this particular analysis, but it's just to show, how valuable a 0% floor in relationship to that cap can really be. So if you take $100,000 and put it into the S&P market directly in 1999, so right before a couple of the bubbles had burst, you'll have somewhere around $94,000 by the time you get to 2010. So you actually would have taken a loss if you're directly involved in the S&P as it's tied to the ups and downs. So again, I'm not going to talk about dividends at the moment. Let's just talk about the loss factor and compounding effects of your money. That same $100,000 in a 0% floor and a 14% cap would be about $212,000. So the difference is nearly double in what you would have had a return on based on having a 14% cap versus an unlimited growth. So one of the reasons why we do that type of analysis, minus the dividends, of course, because I want to be fair, is just to show that the losses can truly impact your ability to catch up. And so irregardless if you're collecting a dividend off of the S&P, you can be put in such a hole with a loss that it's going to be a lot harder for you to climb back out. When we look at these 0% floors and these caps, in those periods of times, even though I wasn't getting the dividend, I also wasn't taking double-digit loss, and my money was still compounding and growing. So in those years that I locked and I got the zero floor, it didn't impact so dramatically the cash value growth or performance in the IUL. So that's one of the reasons why we look at these contracts so much, and we say, hey, with a caps hovering around, I think the average right now is about 12. That's a really good opportunity to get some decent growth and double your money, just as you would want to double your money in an equity strategy.
Well, I was in a conversation with a producer. The producer says to me, Steve, I really I did a study of the S&P back all the way down to 1928, which I'm thinking, well, there was no S&P 500. It was I think it was S&P 90. Right, there wasn't that many around. And he says, I like dividends. And since the S&P is made up mostly of dividends, I say, I have no problem with that. And it is. Dividends are great when they're there. I just want to know, can you handle a loss like we took in 2001, 2002, 2003, and 2008? The last 10 years, we took 4 years that were negative years. Could you handle that again?
And not just slightly negative years either.
Oh, no.
I mean, we're talking seriously double-digit, nearly half a loss in the S&P value. So
I have a crater in my portfolio.
Yeah.
I mean, after you've lived through this, here you got two generations represented here. I'm sitting here hoping that we don't have any real devastation just before I retire. They're just starting out. Eric's just starting out. I'm thinking like, holy mackerel. He starts out, and the last 10 years, 4 out of those 10 are losers.
Well, think about it. I've been contributing to a 401k personally for 12 years. And so right off the bat, once I got a little bit of cash in my 401k, I went through the dot-com bubble. And it wasn't just 1 year, it was a couple of years. Right. So we didn't know what to do. And nobody was there whispering in our ears, move it to fixed, get in the money market, or get into CDs. So what we were doing is we were hoping that the market was going to recover so dramatically that we were going to get all our money back. Well, it didn't happen. It took quite a bit of time. So by 2006, 2007, just as this thing was cooking back up and I was starting to be happy again about the results of my 401k, we had 2007, 2008, and most of those funds actually started triggering in 2007. It was a timing issue. Did you get out in time? Did you move your money in time? Were you in China? What were you invested in at that time? And it depends on how big of a loss you took. So just in my 12 years, I've seen half of my 401k go away 4 times. And so that's impacting. So I'm the generation, mid-30s, I'm the people that our advisors should be going to and talking to when it comes to these types of opportunities. And put VUL on the table because I'd still be open to it, but I'd probably be more open to that index if you show me some historical numbers and show me that I've got the zero floors and even a double-digit cap.
I think one of the things he said in the other one was, in yesterday's show, Eric says, look, you should have one part of your portfolio in an insurance product to guarantee a floor and a foundation for your finances. It just makes good sense, especially after you said the last 10 years. Hey, remember, you can watch this show and all our shows by clicking on the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.